Hi, everyone. This is the lecture video for what I am calling Chapter Zero for our managerial accounting class. And in this presentation and in these slides and the materials that you have available to you in Canvas, things like the in-class exercises, homework exercises, etc., that are all housed within this Chapter Zero concept. This is kind of just a starting point to get us rebooted to kind of the topics that you will have worked with in financial accounting. Maybe you took intro to accounting. Um, and I'm just kind of presenting this initial chapter zero as a way to both hopefully reboot some of that knowledge if you've been away from it for a while. Even over a summer, it might have gotten a little rusty in terms of the concepts we talked about in financial accounting, and then hopefully kind of provide a bridge between what we talked about in financial accounting to what we're going to start in with in our managerial accounting class. Okay, so to begin, this just kind of speaks to what I just mentioned. We're going to take managerial accounting this semester. That's what this course is. And while managerial accounting is relatively different than financial accounting in a lot of ways, we're not going to spend as much time with financial statements necessarily the same way we did in financial accounting. We're not going to spend quite as much time, building all those foundational skills, the debits and credits, understanding how to do journal entries, adjusting entries, understanding all that kind of important foundational work that you need to begin your journey in accounting. We're going to take all that information, and in managerial accounting, we're going to kind of look at some different things. We're going to look at manufacturing companies and how they analyze costs and expenses, and not only how they analyze those, how they aggregate those concepts, etc., in order to understand the cost of the products that they create. That's going to be a big focus of the first few chapters in managerial accounting this semester. So again, we just need to reactivate some of these concepts. And the hope with this chapter and just with managerial accounting, like I said, in the first few chapters, is that we're going to pivot a little bit and really not, maybe not pivot, but use that information that we previously gained in order to start this path down managerial accounting to understand how to analyze costs when you're making a product. That's not something that we typically look at in a typical financial accounting class or intro accounting class, etc. Okay, so what are the concepts that we're going to be trying to reactivate, if you will? We're going to talk about the accounting equation here in chapter zero, normal balances, kind of just that idea of debits and credits, what increases and decreases different types of accounts. We're going to briefly talk about the income statement versus balance sheet. So we're going to look at financial statements a little bit. Inventory as an asset. Like I mentioned, the first few chapters in managerial accounting, we're really going to be talking about cost accounting, aggregating costs, assigning those to products from a manufacturing company perspective. So we really need to understand inventory just as a general concept, and then we're gonna move down that path, like I said, in managerial accounting to layer on the idea of a company that makes their inventory as opposed to buying it, which is likely what you would have been working with when you did your work understanding inventory accounting in an earlier class. In line with this understanding of inventory, some other kind of inventory related topics we're going to touch on: cost of goods sold, gross profit, and just the basic merchandising inventory flow. And remember that also some basic business type terminology. So a merchandiser is a business that buys products to resell them, just, like a corner store, or like a Walmart, a company that doesn't make their products, but instead buys them, sells them. Another term for that would be a retailer. Maybe a lot of you have worked in retail. When we say that, you're working for a store selling products to customers that store has purchased from a third party. And so we first want to understand that basic merchandising inventory flow. Again, we already touched on this in earlier classes like financial accounting, but we want to understand that as kind of a beginning point, because in managerial accounting here, we're really going to dive into the concept of not a merchandiser, but a manufacturer. And so we're going to just build on those basic concepts to understand how companies that make their products for sale, they start with just raw materials and they bring those all together into a product that eventually gets sold. That's what we're going to start with in the kind of chapter one, if you want to think of it as the normal chapters or the rest of the chapters. Chapter one, especially in the first few chapters, we're going to kind of pivot a little bit and look at some other topics as we move through the course this semester. But we are going to be starting with these cost accounting ideas, or analyzing the costs associated with the production of inventory. Okay, so to begin here, let's talk a little bit about this very foundational concept. This is probably something that you were introduced to on the first or second day of previous accounting classes that you had, either intro or financial accounting, etc. And that is the accounting equation. So hopefully that rings some bells. And the idea of this accounting equation, it really comes down to this idea of balance. You can kind of think of it; it's often illustrated like a scale, like it's balanced. You've got the same weight on both sides, kind of an idea as a conceptual idea, and that gets reflected mathematically with our accounting equation, where we have assets on this side of the equation, and we have liabilities and equity on the right side of the equation. And so when we're doing our accounting work, if you recall, you always have to balance. So you always have to have the same number on this side as you do on this side. If that didn't happen, then this equal sign wouldn't be accurate, right? So that's what this formula is basically saying. So at any given time, when we are to look at a company's assets, liabilities, and equity, and put those into this equation, we should have assets equal to the combination of these two um, amounts here, what we have for liabilities and equity. You could have zero liabilities. Remember, maybe you have $1 million of assets. Maybe you have no liabilities, so no debts, and that's all just equity. Or maybe maybe you're a company who just started and you borrowed $1 million, and so you have no equity yet. You haven't made any sales. There's no funds that have come into the business in any other way besides borrowing. And so then you might have, like I said, $1 million of liabilities. You owe $1 million back to the lender, the bank, and then you would have that cash in your business, though. So your assets would be $1 million. A million equals a million. No, if we had a zero. So that's that core concept idea. That's really foundational. I know in earlier classes you probably spent a lot of time on this. So really important starting point. It still applies. We're not going to work quite as much in this course with making sure our journal entries balance and our equation, our accounting equation balances and all that kind of stuff. But we'll spend a little bit of time here in the beginning part just to, again, like I said, reactivate that knowledge for you. Everything still lives inside this relationship, regardless if we're talking about financial accounting or managerial accounting. Okay, so along, kind of with that real foundational concept of the accounting equation, another foundational concept is the use of debits and credits when we're doing our accounting work. Now, in this managerial accounting class, it's not heavy on the debits and credits like financial and other earlier accounting classes are necessarily, but do know there is some work with some journal entries, and we'll talk about debits and credits. And we still want to keep that. We want to have this information handy in our minds because we are still working with expenses, we're working with assets, inventory, these costs, all these things. And when we're still using accounts when we're doing managerial accounting, right? And so we still want to know when we still want to be able to use that terminology. If an asset is increasing, if inventory is increasing, we're debiting that account, right? That asset, to increase it. If expenses are increasing, we want to know that we're debiting that. And so just to be able to move efficiently through accounting and understand terminology, it's important that you still keep a decent grasp on this idea of debits and credits and how those affect different types of accounts, right? So you might have learned the DEAD Circle acronym or some other acronym kind of, I guess it's an acronym, or maybe it's a mnemonic device. The exact, not sure which is the exact right term there, but a word that's funny that kind of jogs your memory, right? And so the idea is that DEAD, if we're using that DEAD Circle acronym, you could have assets, expenses, and then something like dividends we didn't show here, but DEAD, those are all increased with debits. And then remember credits as the CRCL side. So we can kind of think of that as C being the top with the credits, and then revenues, liabilities. You can think of things like contributions on the other side, but equity kind of falls in that same category. So, not that you are going to spend quite as much time in this class memorizing and working with debits and credits and knowing which side of the T account to increase or which side of the journal entry to put amounts on. But like I said, these concepts are still very much foundational and applicable in everything we do in accounting. And so, try to refresh that for yourself and get strong in that as much as you can. You're gonna do well in any accounting class you ever take. The more that you understand about debits and credits and how those are used, that's kind of just the language that we work in. So it is important still, even though it's not a primary focus of managerial accounting in this class. And like it says here, we're going to follow these costs as they move through inventory accounts. So a lot of times costs, we kind of use that interchangeably with expenses, but we are going to be capitalizing or accounting for certain costs as into inventory as we're producing items. So again, understanding just all these foundational things, the terminology. I also want to mention at the same time, don't think that coming into this class, if you're a little rusty on these things, it's any kind of significant barrier. I just kind of want to set the stage for you. And again, this whole chapter 0 is intended to get you up to speed with, like we said here, just enough for our purposes. Not that you need to be a master accountant at this point by any means. Okay, so let's talk about some of the financial statements again that you will have touched on in an earlier class, like financial accounting. And so, one of the core financial statements that we produce as accountants is called the income statement. And from a very high level perspective, just the basics, the income statement is a financial report. And if you recall, that shows it shows us how net income is calculated for a given period of time. That's kind of an important concept there. And to arrive at net income, we are looking at our revenues, amounts that we earned, minus expenses or expenditures that we had of our assets in a given time period to earn those revenues. So pretty basic concepts. I think most of these words are relatively common, I think, in our vocabulary. So hopefully everybody's kind of familiar with these, and obviously a primary focus of the classes you've taken previously. So revenues minus expenses gives us our net income. We're always talking about a period of time. So for a given month or a quarter or a given year, we have to have some time period when we're talking about the income statement. So we can say during the year 2025, we earned a certain amount of revenues, we incurred a certain amount of expenses, and that meant that we earned a certain amount of net income, right? You need that time period concept there to have that whole idea kind of makes sense. It wouldn't make sense to say exactly at a point in time you're earning revenues and expenses and earning. That all happens over a period of time. And then let's contrast that with the balance sheet. So that's kind of our a second primary financial statement. And the balance sheet is at a point in time, if you recall from those earlier classes. And essentially on the balance sheet, it's going to very much look like that accounting equation. We're going to have assets, we're going to have liabilities, and we're going to have equity as kind of overarching sections within those areas. Like assets, you're going to have different types of assets. You'll have current assets, long-term assets, plant, property, and equipment. You're going to have accounts receivable, cash. You're going to have all those different types of subcategories. But from a very high level perspective, remember that on the balance sheet, we have assets, liabilities, and equity. And that is at a given point in time. So whereas with the income statement, we're saying, hey, we earned a certain amount of net income last year, which is basically saying over that whole year. When we're looking at the balance sheet, we have to say, what is as of a given day, maybe the end of that period, on December 31st, 2025, our balance sheet showed this amount of assets, this amount of liabilities, and this amount of equity, right? So two different time kind of concepts that apply to both of those financial statements. And then some of the key things here that we want to take with us into managerial accounting is the idea that unsold inventory or inventory that is sitting out in a warehouse, right? And that's really kind of just a jump back to that idea of a merchandiser. When they buy inventory and sell it, usually they're receiving a finished good. It's packaged, it's ready to be resold. Maybe they have it in a warehouse, and then they sell it and they ship it out, right? Or it's in a store. Maybe it's a clothing store. It's out on a rack somewhere. Again, maybe a lot of you have worked in retail, and that's the idea that that inventory that's a sweatshirt or something sitting on a rack, where customers are coming and looking at it, that is owned by the business, and it is an asset until the time that it's sold, right? And then the company earns the revenue. But until it sells, it is an asset. It's a physical thing. It's there. Um, and we're very much going to take that idea with us into managerial accounting again, but changing the focus from not a merchandiser who buys things ready to go packaged, a finished good ready to be sold, but instead we're going to work with some components of inventory like raw materials and combine all that. We have labor that goes into it. We've got a factory maybe that's building the products, or however that production process occurs. And so we're going to be making the assets that we sell, and all of those components of the assets that we're going to be making are also inventory. And the intention is that we arrive at a finished good eventually, right? When the production process is finished, and maybe then we sell that product to a merchandiser, possibly. So then, they sell it. Sometimes you hear merchandisers called middleman. That's a term used because that company, the merchandiser, sits between the manufacturer and the customer. And so in this class, in the first few chapters of managerial, we're going to change our focus from the merchandiser kind of middleman perspective to the manufacturer who's actually, producing these products in the first place. And the same idea still applies, is that inventory that we create, even if we're building it versus buying it for resale, we're producing it, it's still inventory. And it's even inventory when it's in an unproduced state. So maybe you have raw components. If you're a bakery and you have eggs and flour and sugar or whatever else, that is inventory as well, that is going to later be combined in order to produce a cake or whatever the product is, basically. So really important inventory. It's kind of where we're focusing when we start the class, and that's a key part of this chapter to reboot your mind in that way. Okay, why is inventory an asset? It has future economic benefit. We expect to sell it. Um, that's the whole idea there, right? And again, there's lots of different types of assets. Remember, cash is an asset. Accounts receivable is an asset. You're going to receive money in the future from someone. There's intangible assets. There's prepaid assets if you're paying for the use, maybe a prepaid insurance contract or rent or something like that. And then inventory is another type of asset. And really, like I said, we're going to focus heavily in the first few chapters here. And then just to talk about the accounting that happens when the product is sold, and this is regardless of whether you're a manufacturer who sells their products directly to customers, or you're a manufacturer who's selling their products to a retailer, or you're the merchandiser who is selling directly to the customer. Regardless of what type of business you have, when that inventory that you own is sold, it's no longer on your balance sheet. It's no longer an asset. It's gone. You don't own that. It's now the ownership of that item is passed on to the customer. And now at that point, you recognize an expense, and we call that cost of goods sold. So hopefully that term is familiar, sounds familiar to you from your previous classes you've done in accounting. And so at that point, and we'll look a little bit more at this in detail, but when that asset is sold, it leaves the ownership of the company, goes on to the customer owning it now, and then the company will recognize a certain portion of revenue, and it will record a certain portion of expense related to selling that product, right? So if the business sold that product for $100 and it cost $50 either to make it or to buy it for resale, either a merchandiser or manufacturer, right? $100 to the customer. It cost the business who either made it or bought it from another company to resell. Let's just hypothetically speaking, in either of those scenarios, the cost of goods sold is still the expense that you would deduct from that $100 of sales revenue to really arrive at what the company has earned from selling that product, because the revenue that it gets directly from the customer needs to have the cost that the business incurred to get that product in the first place accounted for, to really make it a valuable metric, or at least, I mean, total revenue can be a valuable metric. But if we want to know what we really earned, and how the business is doing, and specifically that line item would be called gross profit, we have to account for the cost of this goods sold. And so again, this is just kind of touching on the topics I just spoke about. The familiar inventory model from financial accounting, merchandising. This is the business. If we're accounting as we are the business, we're buying finished goods, goes into our inventory. We're housing that inventory somewhere, either in a warehouse or on a store shelf or wherever. And then we eventually sell it to a customer. And at that point, it becomes cost of goods sold. And again, a merchandiser buys a product already ready for sale. And when we think about ready for sale, you might want to start thinking about this term finished goods. We're going to use that a lot from a manufacturing perspective, and it's more or less, it still applies in this regard. Anytime we're talking about inventory that's ready to be sold, we can call that finished goods. Okay, so let's look at an example here again of a merchandiser, something we will have already seen from earlier classes. So let's just assume this boardwalk skate shop. If we have a skate shop here that buys a completed skateboard from the supplier for $60, and some of you might have heard the term wholesale, and that idea, that term is used to kind of speak to this instance, right? If you're buying something wholesale, typically that's a merchandising business purchasing items from a supplier or a manufacturer that's then going to sell them on to the customer. And a lot of times those are intended, for a business to be buying kind of bulk quantity. And when you're buying at a bulk quantity, usually you're getting a bit of a discount. And then that discount helps to for the you can add some more cost onto that when you sell it to the customer. So then that merchandising business is making a profit, right? A gross profit here. So we buy it from a supplier, we sell it to a customer, and I'll just say this, just if this is something you thought about, it doesn't. We don't necessarily always just have to have one middleman as well, right? You could have a company that makes skateboards actually in a factory from the wood and all that stuff. Then that might go to a separate business, and then that might go from that business being sold to an individual skateboard shop, and then it gets sold on. So this is kind of gets into the whole thing of like a supply chain, and supply chains can be definitely more complicated and complex than just a manufacturing business produces something, it goes to a store, a merchandiser, and then it goes to the customer. Maybe that goes without saying, but I just figured I'd mention that just for some context. So yeah, if we sold it for $100, revenue would be the 100. 60 would be what with our cost of goods sold, what we paid. And again, remember, we don't record that expense. We would record this skateboard as an asset on our balance sheet if we didn't sell it until we sell it. So if we didn't sell it for 6 months, that would just remain as an asset on our balance sheet until the point we sell it. And then once we sell it, we record the cost of goods sold, and we subtract that from the revenue to arrive at the company's gross profit. And this is an important metric because this really speaks to what our merchandising business, if we're a skate shop, how much we're actually making, right? If you sold $100 skateboard and you actually paid 120 for it, you'd be losing money. So that's why I said earlier that the revenue is it's not to say it's an irrelevant metric, but it definitely doesn't tell the whole story, because you really need to factor in the cost of goods sold to ensure that you're making a profit in your business. Because if you're not selling things for more than you're buying them, you're not going to stay in business long if you're having a loss on your items. Okay, a little bit of detail into this concept of cost of goods sold. If we want to calculate this amount of cost of goods sold, and really looking at it from the perspective of more of a periodic inventory model, say that is not being accounted for every single time that there's a transaction occurring. This is kind of the high level formula we would want to use. And that is to say, if we knew what beginning inventory was, let's just assume we're looking at cost of goods sold for a given month. If we knew what beginning inventory was, if this was a certain amount of inventory, and then we know how much we purchased, And then, so that would be all of our inventory we had that was available for sale over that given month, right? What we started with, what we added on. And then if we were to just come out and look and see, okay, if we had this periodic system, like I said, where we're not tracking every single individual sale, say we were just coming out at the end of the month to say, okay, we don't know how much we really sold, but we're going to be able to figure this out because we know how much we have now at the end of the month. If we take these two amounts, which gives us a total that could be sold, then we go out and look at the end of the month and say, well, here's what's left over. Then I maybe with the caveat that, there are other ways for inventory to leave, say, a warehouse or a business. They could be stolen, it could be destroyed somehow accidentally, it could be damaged, etc. But let's just put those to the side. So if we assume it's only either here or it's sold, then whatever's not still here at the end of the month has to be sold. And that's what we could calculate cost of goods sold just by that logic. What started, what came in, what's left, and all that's, it either has to be what's left or what was sold, essentially. So that's kind of this big picture basic idea. And we're going to use a similar type of logic in a chapter 1 once we dive into that, where we have something at the beginning, we add more into it, and then we subtract out what's left at the ending to get some different amounts that we're going to use in some calculations. So just sort of understanding the basic principle I'm talking about of what started, what came in, what's left, and what, that being the other part of it. It's either here or it's gone. We will use this basic formula again. So definitely, spend a little time, make sure that makes sense. We'll practice with this, on in-class exercises and homework. But feel free to reach out and, in class, ask a question or anything. Just get this concept to make sure that makes sense in your mind, just from a high level perspective. So let's just look at a quick example of this idea of cost of goods sold and these calculations. So if beginning inventory was 12,000, we purchased 48,000. Again, this gives us our total that could have been sold during the month, adding these together, so 60,000. And then we go out to the warehouse at the end of the month and say, well, we see there's actually there was 60,000 that could have been sold. We have 15,000 left. So the difference between those must have been what was sold. And that would be our cost of goods sold. And so this is just kind of a high level basic formula for calculating cost of goods sold. Again, like I said, the overall logic of starting with a certain balance, adding more into it, and subtracting the ending amount is something we'll use again. So hopefully that will make sense to you, and definitely do some work if it doesn't to confirm that in your mind. Okay, so let's talk about gross profit a little more. We touched on this quite a bit, so I might not spend too much time here, but again, gross profit is the idea of what did we sell something for, or if you're talking about a whole month too, total sales revenue minus total cost of goods sold leaves us with our total profit for the month. Now, there's an important distinction to make between gross profit and net income. And so net income is another term you'll remember from earlier accounting classes, and you'll remember from, I'll zoom back up, earlier slides here, right? We said on the income statement, revenues minus expenses equals net income. So we've mentioned that already, just in this chapter. And the important distinction we're making is that this gross profit number here is only accounting for the sales revenue that we earned minus the cost of goods sold, what it costs us to buy that product, right? That doesn't take into account any of the other costs that a business incurs just running the business, right? If it's the skate shop, all we talked about in this instance was the cost of that skateboard minus the costs to the customer, the revenue earned from that skateboard sale, minus the cost of goods sold. That's just the gross profit, right? So then a skate shop, for example, is still going to have lots of other operating expenses. It's going to, have utilities, have the lights on in the place. You're going to, if you have employees, you're going to have costs associated with payroll. If you're going to have probably insurance on your business, there's always business insurance concerns. You're either going to have to buy a business or a location if you owned it, but a lot of times, you're paying rent to be in a location. Just a whole, host of other things that go along with operating a business in general, other than just the cost of buying the good. So those are called operating expenses. And if we're going to calculate net income, those are some extra expenses that we need to add on or I guess I should say subtract from gross profit to get us to that net income amount. So again, gross profit is not net income. It's just the amount of profit earned from sale of products, factoring in the revenue minus the cost of goods sold. And to get to net income, we have to account for all the other expenses of the business. Taxes, those are an expense no business can generally avoid. Okay, so let's look at here at a little bit of the sales. We've talked about gross profit and sales revenue and cost of goods sold. Let's look at the nuts and bolts from an accounting perspective a little bit. Again, you will have touched on this from earlier classes, but let's revisit. So there's two pieces when you have um, a transaction occur and we're doing accounting for the sale of inventory. And if you remember, there's four lines that we usually record. Four different entries, if you will, for a journal entry. Maybe two, you might have also done two different journal entries. With two balancing accounts affected in each of those journal entries, but four total. And those break down in one, recognizing the revenue earned. That $100 we talked about previously with the skateboard, and we also need to do some accounting, as we talked about, to move that product cost from an asset to now an expense, right? Because we don't have that inventory anymore. We need to record cost of goods sold so we can reflect, gross profit and sales revenue accurately. And then we also need to account for the fact that we earned some assets from selling this product. We either got paid cash by the customer right away, or maybe we did something where we're going to be paid later, accounts receivable kind of thing. But we also want to record the revenue associated with that, because that's going to be a component of our calculation of gross profit, right? So that's what we're going to do with our accounting. And we'll dive into the nuts and bolts a little bit in our in-class exercises more and homework as well. Again, we're not going to get real heavy on journal entries in this class and spend tons of time on debits and credits, but in these early chapters, and especially in this chapter 0, we are going to spend some time just refreshing ourselves on journal entries and inventory specific related journal entries. Okay, so this is just saying, hey, if we're going to pivot to this thought, process, or a new concept here of managerial accounting, what happens if we don't buy the completed skateboard for $60, right? I mean, what if we make it ourselves? So what if we're not just selling this skateboard? We're selling the skateboard still, but we didn't buy it from a supplier. What if we have a warehouse or a factory where we're actually taking wood and we're cutting it into skateboard shapes and we're shaping it and we're doing all the things, drilling holes and all that kind of stuff? That's what we're going to kind of change in managerial accounting, especially in these early chapters, to look at it from the manufacturer perspective. So again, changing our thought process from what did we pay for the finished product from a supplier to what did it cost us to make the product. And so when we're pivoting to this managerial accounting focus and perspective, that's where we're going to need to start thinking about this, and then developing some systems and processes, which again we'll jump right into in chapter 1, to allow us to track the materials. So like raw materials, if you're making a skateboard, wood and whatever else goes into making a skateboard. Labor, if you have some employees out there who are cutting the wood and shaping it and doing the whole thing, there's labor costs associated with that. There's factory costs, either renting the factory or buying a factory, etc. The depreciation, if you purchased a factory, if you remember that depreciation from earlier chapters. You got machinery costs, machinery depreciation. You got electric, you got utilities with a factory, all those kind of things. So we still have to think about, what did it cost? What amount of expense did we incur to get this product in our hands to be able to sell it? And it was pretty easy with merchandising, because we always, in financial, if you're a merchandiser, you just say, well, we know how much what the expense was for cost of goods sold because we just paid for it, right? And there's some different ways to account for that, if you recall back with FIFO, LIFO, weighted average. So there's a little bit of nuance into how cost of goods sold gets calculated for a merchandiser, with different treatments under GAAP that are allowed. But when we're looking at manufacturing, it gets a little more complex, or a lot more complex, to be honest. This is a field where you can have people who are simply just cost accountants. This could be a whole team of people whose job it is to do all this tracking of information and analysis of information, et cetera. And why do we, why is it important? We want to calculate gross profit again, right? And so if we were to create one skateboard and sell it, we want to know as a business, how much did it cost us to make that skateboard to sell, so that we're accurately pricing the skateboard, right? Again, if we don't want to price it below what it cost us to get it, or we're going to lose money, right? And it's definitely more complex to do that when you don't just have, you're not just paying for that finished product and say, oh, we paid 60, charge 100, awesome. If instead you're having to look at, oh, here's all the wood that we bought and the costs associated with that, here's all the payroll costs associated with all the warehouse employees who built this thing and created it, produced the skateboard, here's all the costs of the factory that we had to incur, right? You can kind of start to see that it's not quite so easy, and maybe all that work and those materials and the labor and the utilities and all that stuff went into all that. Maybe we produced 100,000 skateboards in a month or a year or something, and so we have to somehow take all of these costs, aggregate them, and then uh, kind of assign those costs to that individual skateboard at a given point, so that we can determine exactly what is the gross profit for, or really it's to determine what was the cost to produce that skateboard, so that we can price that at an accurate place and make sure that we're able to make a profit when we're selling the thing, right? So adds a lot of complexity. It's definitely something we're going to spend a lot of time on in this class understanding. And then just do know, this is why cost accounting is kind of its whole own field of accounting. And again, like I said, you could have a whole department of people accountants whose job it is to do this kind of work and do this analysis. So if this really speaks out to you in this class, I guess I'll say, and you think this is something that's really interesting, yeah, you can really keep going with this. There's some specific certifications that are kind of more geared towards doing this type of work and cost accounting and whatnot, aside from just the CPA certification. If you're a CPA, you can definitely get into this kind of work too, and you don't need to go have a CPA or anything. This is just another job field that kind of opens up to you with an accounting, when you have accounting information or an accounting degree or certificate or just job experience, etc. Okay, so let's talk about the manufacturing inventory flow then. I talked a little bit about this before. So the merchandising flow is real simple. You buy it, you sell it. You buy it and it's inventory on your balance sheet. You sell it, it becomes cost of goods sold. It's an expense, it's gone. Now with a manufacturing business, we're going to be having different categories of inventory as it works towards being a finished good, right? We're just buying the finished good as a merchandiser, but as a manufacturer, we need to account for all of our raw materials. So if you're a bakery, for example, we need to initially account for the purchase of all the flour and the eggs and the sugar and all the other stuff that a bakery might purchase. That's still inventory. It's just not in a finished goods state yet. And so that raw materials inventory that's sitting out in the in some cold storage or whatever, but in, kind of in a warehouse, I guess, for the business. That's still inventory, but it's not finished goods yet. It's going to start as raw materials, become work in process. So we kind of have an intermediary category. So if you want to think about this from a bakery perspective, you got eggs and flour and stuff, then if it's in the process of being, mixed in a big mixing bowl, and it's working towards, it's not sellable yet, it's in the intermediate stage of being produced, that's called work in process. WIP you'll hear sometimes. You might see goods in process used in some places. Sometimes some textbooks use that. I like the WIP and work in process. It just, I don't know, flows off the tongue easier. It's commonly used. I need to learn. I think it's an acronym. I need to learn the difference with an acronym and a mnemonic device. But I think it's an acronym. Anyway, you'll hear WIP a lot. Raw materials. It becomes work in process, and then once it's all done, it's done being mixed. It's been baked. It's all packaged up. It's ready to be sold. Once it's in a sellable state to go to the final customer, then we're going to call it finished goods, right? And again, that could sit on the shelf for a while and just be finished goods inventory. It could be work in process inventory if it's not, finished yet. It could be raw materials inventory. All these are inventory categories until the point at which the customer has that purchase, makes we make the sale of the product, and it's gone. We don't have that cake anymore, or loaf of bread or whatever. And instead, we're going to record some expense on our income statement to calculate gross profit related to the sale of that loaf of bread or cake. And that's going to be cost of goods sold. So again, this just kind of reiterates, it remains assets. So these are all assets. They're all inventory categories. You've never seen these in financial accounting. This is manufacturing related only, right? We just looked at merchandisers typically in financial accounting because it's simpler as you're learning those core concepts. But these are all different inventory classifications. It really just moves down through this process to become cost of goods sold at the end. And so, like I talked about previously, manufacturing, it adds a relatively complex challenge of accumulating all these types of costs. And while the product is being made, assigning those accurately to individual finished products, which again, it could be relatively difficult. And we'll talk about that through the next few chapters. There's different methodologies. Sometimes it's a little simpler if you're making a product that's real big and stands out like a good example, some custom thing that you can pretty easily see all these costs going into the production of a big product. Like think of like an airplane or something. Like if your company makes airplanes, it's pretty easy to track all of the parts and the costs that are going into, say it's a custom airplane, right? And so all the costs going into production of this custom airplane is relatively easy to look at that plane when it's done and say, yeah, we have all the invoices and the records that who worked on this thing for payroll and all that kind of stuff. Pretty easy to see all the costs that flowed into that big old unique asset, right? But if you're talking about something like, cornflakes or something, and you've got all this labor and utilities and rent and all this kind of stuff, it becomes a bit more challenging to take all of those costs for this product that's very homogeneous, right? It's not unique. It's hard to allocate those costs easily. And so again, that challenge can really kind of be different based on what kind of products you are making as well from a manufacturing perspective. So even within this pathway of manufacturing and cost accounting, et cetera, there's quite a bit of variety even within that field, depending on what the product is that's being produced. Again, okay, this is pretty, I won't spend too much time here. I just talked about this, but raw materials, again, inputs waiting into production. Think of like bakery, flour, eggs, sugar, etc. Work in process, that's stuff that was started but not yet completed. And then finished goods are totally finished, packaged up, ready to be sold, and sitting on the shelf somewhere or being sold to maybe to a merchandiser, like a grocery store. Grocery store is a good idea, a good example of a merchandiser, right? And so maybe Kellogg's, is the manufacturer, the Safeway or whatever grocery store, they're the merchandiser, the middleman, if you will. And then the final purchase, comes when you're at the grocery store. Okay, so some of the key continuity bridge ideas to keep in mind here as we kind of wrap up this lecture. Financial accounting ideas here. Inventory cost is an asset until the product is sold, right? Really core concept. And then managerial accounting, we're going to add in how is that product cost created, right? So that we can start doing some of this analysis and application of those costs out, allocating those costs to individual products, etc. So just to wrap up this lecture, next we go inside the factory. So this will be we're kind of moving in this direction for chapter 1. We are going to do, I think, 2 days I've got on the schedule for in-class exercises and work in this chapter 0. So this isn't the end that you're going to hear of chapter 0, just this lecture necessarily. So we are going to go inside the factory. We're moving towards chapter 1. But I do, you will watch this lecture video first. There's an associated notes sheet, kind of a template to fill out. That'll be one of your first assignments after reading the handout for chapter 0, watching this lecture. You're going to fill out your notes. We'll talk about this in class, etc. And I'll have some video guidance on that as well. But that's going to be kind of your first starting project, and how this class proceeds to. Every chapter will have a lecture video, some associated notes to kind of, guide your thinking and help you retain the information. just to add a little bit on the workflow part of that, you're gonna watch this lecture video, fill out the notes, upload those to Canvas, get your points. You're gonna come into class, look on our calendar for the specific dates here, but it will be basically the second day of class. You'll come in after watching this video and filling the notes out. We'll do a quick 5-question quiz at the very beginning of class. Relatively basic. The idea there is that as long as you did your notes and watched the lecture video and read the associated reading, you should be able to get 5 out of 5, or at least a good score on those notes quiz. They're I intend to make them relatively easy. It's really just a check to ensure that you've got through the preparation that you're supposed to as we move through the chapters. So from there, after we do our notes quiz, then we'll start jumping into some in-class exercises. You'll have some associated homework, and so you'll have a lot of hands-on time to work through these concepts as well. Not only just chapter 0, of course, but this will be a similar workflow that we follow throughout the entire semester with each chapter. So you'll get lots of exposure. I find that in accounting, you can listen to me, and this is great, but the real learning happens, especially for kind of the methodologies and procedural stuff we're going to do. That's all going to happen by doing the work, when you're in class, you're putting the pen to the paper and actually just, working through these handout templates that I'll hand out to everybody in class. And then when you're doing the homework, those are typically online, kind of Excel based homeworks. And so, yeah, you'll get some extra Excel practice in this class. If anyone's taken my classes before, you'll already know this, but I will have copious amounts of walkthrough videos with each homework assignment. So you should never feel too stuck, and you should always have that. You will always have that resource available, more or less, usually showing me walk through pretty much the whole homework assignment start to finish. So my idea there and my intention is just that you never really feel lost when you're doing your homework, and when you're doing your in-class exercises. Obviously I'm there in class to help. When you're doing your homework, you have the lecture video, and then just to add on top of that, you can always reach out. I've got office hours. I'm accessible via email. You can call my office phone number. So my goal is to support you all as we move through this course. Hopefully this chapter 0 is going to be helpful to reactivate your accounting knowledge that you've picked up along the way, and just kind of set the stage for what we're going to do next as we move into managerial accounting. So thanks everybody for watching along. I am glad, excited to meet everyone taking this course. I really have a lot of fun with this course. I think managerial accounting is really interesting, and I find that a lot of students like this class potentially even more than financial accounting, because it starts to add in the layer of more decision making, somewhat more like real world business management. It's managerial accounting, right? So we're going to actually step a little bit away from the rules based debits and credits and GAAP financial statements and all that kind of stuff, and look at how we can use this accounting information to make decisions, to price products, to do things of that sort, that are what I find a lot of students find a little potentially more interesting than maybe more of that dry US GAAP financial statements, debits and credits. Now, if you're, if you like solving puzzles and you like doing both, I wouldn't say accounting never gets away from either of those. I think I like both quite a bit. So don't feel like it's one or the other necessarily. But I do find that a lot of students think this class is relatively interesting, and maybe more interesting than financial accounting, because it does layer in some more, a little more subjective decision making, and makes things a little more real world in some ways. So, all right, well, I will wrap this thing up. Thanks everybody for watching along to the end. I look forward to working with you all this semester, and keep an eye out for you'll see some more videos as you proceed through this chapter 0 that will help guide you through the homework. And yeah, I'm excited to get started. Thanks everybody. I'll see you in class.